In this video, we want to take a closer look at Chainlink compared to Ondo Finance. Let's begin. While Chainlink quietly became the most essential infrastructure in crypto, processing over $12 trillion in transaction value without most users knowing it exists, Ondo Finance grabbed headlines by doing something radically different, convincing Wall Street institutions to put their treasury bills on a blockchain. One built the invisible plumbing that makes decentralized finance possible. The other is packaging traditional finance for crypto investors, yet both claim they're solving the same fundamental problem of bringing real-world value onto the blockchain. We will show why Wall Street plays the most important role in this game and not necessarily technology. Will one of the two come out on top in the end, or will they coexist? If you've made it this far, please subscribe to the channel so you don't miss out on more facts about coins and projects like these. The problem of when crypto can't talk to reality became brutally apparent between 2017 and 2024 as the infrastructure crisis threatened to derail blockchain's entire promise. Smart contracts executed flawlessly within their digital domains. But the moment they needed information from outside, stock prices, weather conditions, sports scores, interest rates, they hit an impenetrable wall. DeFi protocols emerged as the first casualties of this information silo. Lending platforms like Aave and Compound required accurate price feeds to manage collateral ratios and prevent insolvency. A single corrupted data point could trigger millions in erroneous liquidations. In 2020, flash loan attacks exploited Oracle vulnerabilities, draining over $100 million from various protocols. Developers watched helplessly as their mathematically perfect smart contracts became weapons against their own users. The trust gap extended far beyond technical failures. Traditional finance institutions observed these Oracle disasters with vindication. Pension funds, endowments, and sovereign wealth funds controlled tens of trillions in assets, yet they remained firmly on the sidelines. Centralized Oracle solutions offered temporary relief but introduced fatal compromises. Single data providers became points of failure and manipulation. Projects relying on one company's price feed essentially recreated the centralized systems blockchain promised to replace. The irony wasn't lost on critics. Decentralized finance built on centralized data defeated its own purpose. Meanwhile, institutional capital faced different barriers. Even investors intrigued by blockchain technology couldn't justify exposure to unregulated, volatile crypto assets. Compliance departments rejected proposals outright. Risk committees demanded familiar instruments, treasury bills, investment-grade bonds, regulated securities. The chasm between crypto's innovation and traditional finance's capital seemed unbridgeable, with no clear path forward for either Oracle reliability or institutional adoption. Failed attempts, the graveyard of broken bridges. The graveyard of broken bridges between 2018 and 2022 stands as a monument to ambition outpacing execution. Early Oracle solutions promised decentralization, but delivered centralized failure points wrapped in technical jargon. Projects like Provable, formerly Oraclize, relied on single trusted entities to feed data into smart contracts. When these services experienced downtime or manipulation, entire protocols collapsed. Oracle exploits became increasingly sophisticated. In February 2020, the BZX protocol suffered two separate attacks within days, losing over $950,000 through manipulated price feeds. Attackers borrowed funds, manipulated Oracle data mid-transaction, then profited from the artificially distorted prices. The mathematical elegance of smart contracts meant nothing when the data feeding them was poisoned. Failed real-world asset projects littered the landscape with even greater wreckage. Numerous tokenization platforms launched with fanfare, promising to bring real estate, commodities, and securities onto blockchain. Most disappeared within months. Victims of regulatory uncertainty, lack of institutional trust, or fundamental misunderstanding of compliance requirements. Security token offerings that raised millions evaporated, leaving investors with worthless tokens backed by nothing. The betrayal cut deepest for believers who trusted these bridges. Developers who integrated flawed oracles saw their protocols drained. Investors who bought tokenized assets discovered no legal recourse when platforms shut down. Each failure reinforced traditional finance's skepticism and widened the chasm between crypto's potential and its reality. The industry desperately needed solutions that actually worked, not more promises destined for the graveyard. The breakthrough: two philosophies of connection. The breakthrough emerged through two philosophies of connection that couldn't have been more different. Between 2019 and 2023, Chainlink and Ondo Finance developed opposing strategies to solve blockchain's isolation problem. Chainlink pursued decentralized oracles as infrastructure, building networks of independent node operators who aggregated data from multiple sources. This bottom-up adoption strategy focused on becoming indispensable plumbing, the invisible layer every DeFi protocol needed but users never saw. No single point of failure, no trusted intermediary, just cryptographic proof and economic incentives aligning data providers with accuracy. Ondo Finance took the opposite path, embracing regulatory compliance as its foundation. Rather than bringing external data onto blockchain, they brought actual assets. Tokenized treasury bills backed by real securities held with regulated custodians. This top-down adoption courted institutions directly, speaking their language of compliance, audits, and familiar financial instruments. One built the highways, the other brought the cargo. Both recognized that crypto's future required bridging the gap with reality, but their methods revealed fundamentally different visions of what blockchain infrastructure actually meant. Chapter 4, Implementation. Building the invisible versus the institutional implementation of building the invisible versus the institutional revealed how technical architecture shapes market destiny. Between 2020 and 2024, Chainlink and Ondo Finance executed their divergent visions with precision, each creating infrastructure that reflected their fundamental philosophy. Chainlink's technical architecture prioritized decentralization at every layer. Their Oracle networks aggregated data from dozens of independent node operators, each pulling information from multiple premium data providers. When Aave needed Ethereum price feeds, Chainlink didn't provide a single answer. It provided cryptographic proof that 21 independent nodes reached consensus after consulting sources like CoinGecko, CoinMarketCap, and major exchanges. This redundancy eliminated single points of failure. Even if several nodes went offline or turned malicious, the network continued functioning with mathematical certainty. The partnership strategy focused on becoming indispensable infrastructure. Chainlink integrated with Synthetics, Compound, and Aave, the foundational DeFi protocols that others build upon. By 2023, over 1,000 projects relied on Chainlink price feeds, securing more than $75 billion in total value locked. The network processed millions of data updates daily, invisible to end users, but critical to every transaction. Developers didn't choose Chainlink because of marketing. They chose it because alternatives meant accepting centralization risks their users wouldn't tolerate. Ondo Finance built institutional-grade architecture from day one. Their technical implementation separated tokenized securities into distinct legal structures, ensuring compliance with securities regulations. The OUSG token represented shares in a fund holding short-term U.S. Treasury bills with proper custody through regulated financial institutions. Every token was backed by actual securities audited regularly with transparent net asset value calculations. Published daily. Their partnership strategy courted traditional finance directly. Ondo collaborated with established asset managers, custodians, and compliance firms. Rather than disrupting Wall Street, they invited it onto blockchain through familiar structures. Institutional investors encountered products they understood: money market funds, treasury exposure, investment-grade yields, just delivered through tokenized infrastructure. Market adoption followed predictably different paths. Chainlink achieved ubiquity through developer adoption. Every new DeFi protocol needed price feeds, and Chainlink became the default choice. Network effects compounded. More integrations meant more data sources, which attracted more projects, creating a self-reinforcing cycle. Ondo captured institutional capital seeking yield without crypto volatility. By 2024, their tokenized treasury products held over $500 million in assets under management. Pension funds and family offices allocated capital to OUSG, gaining blockchain efficiency while maintaining regulatory compliance and stable returns. One became the invisible standard powering everything. The other became the visible bridge bringing traditional capital on-chain. Both succeeded by building infrastructure their target markets actually needed, not what crypto idealists wished they wanted. Results: the numbers don't lie, but they're complicated. The results show that numbers don't lie, but they're complicated when comparing fundamentally different business models. By 2023 and 2024, both Chainlink and Ondo Finance posted metrics that validated their approaches. Yet measuring success required understanding what each project actually aimed to achieve. Chainlink's market metrics reflected infrastructure dominance. The Link token reached a market capitalization exceeding $15 billion at its peak, ranking consistently among the top 20 cryptocurrencies. More importantly, the network secured over $75 billion in total value locked across integrated protocols. Daily Oracle updates numbered in the millions, feeding price data to virtually every major DeFi platform. Over 1,400 projects integrated Chainlink services, creating network effects that made competitors nearly irrelevant. Real-world impact manifested in what didn't happen. Oracle failures that would have drained billions from DeFi protocols simply stopped occurring at scale. The infrastructure became so reliable that developers stopped discussing Oracle risk as an existential threat. Chainlink's decentralized networks processed data for lending, derivatives, insurance, and prediction markets without the catastrophic failures that plagued earlier solutions. Ondo Finance showed different but equally impressive adoption curves. Their tokenized treasury products grew from zero to over $500 million in assets under management within 2 years. The Ondo token launched and quickly established a market presence, though its valuation reflected different dynamics than pure infrastructure plays. Institutional clients included family offices, hedge funds, and traditional finance entities exploring blockchain without cryptocurrency volatility exposure. Their real-world impact measured in capital migration, actual dollars flowing from traditional finance into tokenized securities. Each institutional allocation validated the regulatory-first approach, Pension funds that would never touch Bitcoin happily allocated to tokenized treasury bills, offering 4 to 5% yields with full compliance. The validation came from different sources. Chainlink proved infrastructure could be both decentralized and reliable. Ondo proved institutions would embrace blockchain if products met their regulatory requirements. Both succeeded by solving real problems rather than chasing hype. Conclusion: the lessons about what infrastructure really means emerge from recognizing that mature financial systems require both invisible plumbing and visible products. Chainlink's oracles and Ondo's tokenized assets aren't competitors. They're complementary layers in blockchain's evolution from experimental technology to institutional reality. The future implications suggest that crypto's next phase demands both approaches: decentralized data infrastructure enabling trustless computation and compliant asset tokenization, bringing traditional capital on-chain. The investment thesis isn't choosing between highways and cargo. It's understanding that building the future of money requires both. Would you like to learn more about cryptocurrencies and the real background? Please subscribe to the channel and write in the comments what you think. Which of the two assets will see the greater price increase in the future?